Money at Work Continuing Education Series. Today's episode and today's installment centers around market downturns and market corrections. So what are they and how do different types of investors fare and come out during these times when you're looking back at historical performance? So first of all, stock market correction. They're an inevitable and frustrating part of any long-term investment journey. How you react to them is really the only thing that you control, because these things will happen, but how you react is what you control, and that's going to greatly affect your investment results. So a stock market correction itself, whether you're talking about the market as a whole, talking about a sector, asset classes, whatever it might be, from a recent high, something triggers a correction of a decline of 10% or more. Now, typically corrections don't last that long. They're maybe a number of weeks, maybe a couple of months, but they're relatively short-lived. Anything longer than that starts to stretch out and possibly become something like a bear market. So the three types of investors that we're going to look at today, we're going to see, typically what makes them up, what's their psychological profile, and then if we were to take these three types of investors and apply a hypothetical situation to a past market event, how would each come out? So first of all, the intimidated investor. This is the person who's just locked into the screens, locked into the news during these market downturns and corrections, and they just can't escape it mentally. They get so overwhelmed and so emotionally involved in the process that they end up, making decisions based on those emotions, which are never a good idea. Second type of investor is the patient investor. This person probably does the opposite. They're really not paying much attention to the day-to-day news during the market downturns or corrections because they've got their eye on a future event, meaning that near term, interim term, it's only having those effects. Long term, they still understand their plan of action, where they're trying to get to and what they need to do. So they mostly ignore the noise. And then the third type of investor is one that I call the intelligent investor. This is somebody who makes data-driven decisions, and based on the environment, they're still looking at different types of sectors or assets or individual companies, and they're identifying when they believe that a good company or a good asset goes on sale, and they're making additional moves with additional capital. There's steps to becoming a better investor, and that's really from learning from past cycles so you can try to forecast future cycles. So when we look at, for example, each one of these investors, the intimidated investor, the patient investor, and the intelligent investor, during a market downturn, see how each would react, and let's see what type of a grade each would get coming out of that time period. So this is going to illustrate some hypothetical investors that we've already talked about who each invested $10,000 at the market highs prior to that 2008 market downturn. So we got $10,000 being invested by each one of these types of investors. Now we're going to look at, of course, this is when it was invested prior to 2008. We're going to look at March 2009 as a decision point, and then we're going to look at the outcome of that as of December the 21st or December 31st, 2021, end of last year. So the intimidated investor took that $10,000, and following that 2008 market downturn, they sold all their stocks and they just went to the sidelines of cash in March 2009. The ending value at the end of last year, December 31st, 2021, $5,087. Obviously not the right move. The patient investor, they did absolutely nothing. They just held stocks through the market downturn, and throughout that period of time leading into the end of last year, they would have an ending value of $40,812. So in this case, it paid to be patient. And then last is the intelligent investor. They view 2008 downturn as an opportunity to buy stocks at lower prices, sale prices. So they actually put additional capital to work, invested another $10,000 in stocks in March of 2009, which creates a total portfolio value in this hypothetical situation, looking backwards, of $132,031. So you can see by the psychological nature of how these people operated and made their decisions, what happened. And obviously, Being driven by emotions is a bad thing. Getting paid to be patient is a good thing. Being paid even more to see things through as an intelligent investor is the best position to be in. Now, the past performance is a great way to look into the future and figure out what typically can happen. However, full disclaimer, past performance is no guarantee of future performance, and everything we've talked about today is just for educational purposes to teach you about market corrections so that you can hopefully make better decisions during those particular periods of time. Market corrections are going to come and they're going to go. But overall, when you look at your portfolio and your goals, if you're a long-term investor, when faced with market corrections, you can't act emotionally like we talked about, and you can't just abandon your investment plan. Be patient, and assuming your goals and or your time horizon have not changed, view the downturn as an opportunity to purchase good businesses at attractive prices. MillionaireMindset.life, straight sure thinking, create your vision, and achieve.